Hello, this is Dr. Flight, and this is a video lecture that is focused on the net marketing contribution, and then also marketing's return on sales, and then also marketing's return on investments. So part of this discussion will include the use of having marketing focused metrics in the reporting of operations within the firm to be able to identify the effectiveness of marketing operations, and the effect that marketing has on income and total sales. So again, this is a discussion on a couple different marketing metrics that can be used to help identify the effectiveness of your marketing activities, and also illustrate the relative importance that the marketing function has in producing income within your firm. Okay, so enjoy. As we begin to think about different tools and techniques that we can use within the firm to identify the effectiveness of marketing, we often think about different measures or different data points that can be beneficial in helping us do this. Oftentimes when we look at reporting profits and reporting the overall financial health of the firm, we look at broad financial measures and such for the firm itself. However, what we'll suggest in this discussion is that we can break traditional financial metrics and measures down a little bit to also include the marketing metrics that go into the overall financial health of the firm. So two things to take away from this is that there are marketing analytics, and then there are marketing metrics. So the metrics are the measurements and the data points, performance measures that we'll use. Marketing analytics tend to be the tools that we use in order to analyze data and make some sense out of it. Marketing metrics, like any other function, are important, or metrics in general are important to marketing like they would be in any other type of discipline. An example here would be different metrics that are used in the healthcare field, in automotive repair shops and things like that, and then of course in marketing as well. So if we want to know how well a process is running, we typically need to have some outcome measurements that we can use and measure and compare over a long period of time. We can see how these outcome measurements are moving up or moving down relative to our own performance, but then also relative to our industry as well. So as we think about analytics, again, these are measurement devices that we use in order to create the metrics that we'll examine. Metrics then are specific measures of performance. Specific measures of performance. For example, a measurement system used to measure customer satisfaction would be a marketing analytic. Then the customer satisfaction index of 72%, which are very satisfied customers, that would be the actual marketing metric. The metric is the number that we measure. The system in which we use to measure it then would be the analytical tool that we're using. So just like any other field, we want to think about different metrics that will help us identify how well the process of marketing is happening. It happens that much of what we do in marketing, much of what a firm does in marketing, can be traced directly to having an impact on profitability within the firm. So it's no surprise that if you have a high market share, for instance, you will most likely be profitable relative to others in your industry. If you keep customers, have high quality that you deliver to customers, if your customers are more satisfied, if they're more loyal, loyalty, satisfaction, customer retention, product quality, service quality, those are all elements that we work on, and they're all metrics that we measure, but they're also tied very closely to profitability, as are the efficiency numbers that we can calculate when we talk about marketing's return on investments. Again, these are all metrics that we use, but they all have a direct impact on firm profitability. So it's important to start thinking about how we incorporate these metrics in how we deliver, how we work within the firm. Any number of different metrics can be used from the marketing discipline. There are metrics that we can think about from an industry's perspective. So if we function from an industry's viewpoint, we want to think about how we stack up against our competition. So our sales growth within the industry, our market share within the industry. We also think about another group of measures or metrics that focus on how well we satisfy the customer's need compared to our competitors. So our product's performance, the service quality, the customer value, the value we deliver to the customer, in other words, and then how well we treat the customers. So customer metrics as well exist too. Satisfaction, retention, and of course customer lifetime value are just some examples of this. So again, these are examples of how we can think about metrics that would measure the different processes that we are engaged in marketing. And again, each one of these have direct influences to the overall financial health of the firm. So the company performance that we want to think about will absolutely be impacted by what we do in marketing. And so as a result, we often want to try to incorporate these types of measures inside the firm if possible. So if we take company performance and we look at typical firms recording data, so we have things like sales, right? So how much do we bring into the firm in sales revenue? We look at the costs of producing those revenues in cost of goods sold, and then we have other expenses as well. If we look at gross profit, right? So what the difference is in revenues and cost of goods sold factored in there. We have our expenses. Oftentimes we only have general and administrative expenses and maybe other expenses, but we could break out of that our marketing and sales expenses as well. So if we're willing to take out from general and administrative expenses from an accounting perspective, if we're willing to withdraw or take out as a separate item our marketing and sales expenses, then we can begin to look at some ratios of the effectiveness that marketing and sales investments have on profit and overall income within the firm. So we certainly have financial metrics that we use, and one of our challenges will be to also incorporate marketing metrics and view them in a way that focuses on the general revenue and performance that the firm has. Here's an example where you can think about like sales revenue over time. We look at how sales revenue in this particular organization has grown. So has cost of goods sold. As volume has gone up, we've had some increase here in cost of goods sold. We also have some positive or seemingly positive numbers and metrics as they relate to the ratios that we would look at. Um, Sales to assets, pre-tax return on sales moving up, and the effectiveness of or the efficiency and effectiveness that we're able to use our assets and in return as well are all going up. So it would seem as though there's some positive things happening with this particular company over time. However, none of this really incorporates marketing performance or the performance of the firm relative to other companies or relative to the market overall. So while this company appears to be healthy and in good shape, if we look a little closer and consider what's going on at the same company by incorporating some marketing concepts, we may not be so convinced that this company is doing as well as we think. So in this example, one of the things that's going on that we don't know from the financial statement is that there's certain industry growth. However, our firm's growth does not match the rate of growth that the industry is experiencing. So this curve here measures the rate of growth the industry is experiencing. This graph here indicates the rate of growth the firm is experiencing, and we see that we're not keeping up with the market. Therefore, we're not, in a relative sense, we're not competing well against other firms that we do business with. This is illustrated also when we look at market share, which again doesn't appear on the financial statement, but our market share over the same period of time, even though the company's on paper making more money, of course, then that looks good, our market share has become eroded, and we haven't been able to keep up not only with the pace of growth, but we have not been able to maintain share at the same time. So again, this is not something that would be picked up necessarily if we didn't make a concerted effort to build marketing metrics into our decision-making processes. So we have what we think of as a well-balanced performance profile if we include financial metrics, which are our traditional financial metrics that you would see. So metrics that are associated with profit, with expenses, with our asset management ratios, and shareholder types of things. These are all typical financial measures that we'll often look at when we look at the health of a company. But coupled with marketing metrics, we can see things that are happening. So like service quality taking a big hit over this last period of time. Other metrics here that we would want to look at are profitability metrics, return on investment, return on sales from our marketing expenditures, net marketing contribution, and so forth. To have a better, fuller view of company performance, we want to incorporate marketing metrics. And also, what's particularly important about marketing metrics are that they oftentimes help predict future performance. So they're forward thinking in many, many ways. And so there's a time horizon where we think about forward-looking metrics and backward-looking metrics. And in particular, we want to look at these things that we can affect here, these forward-looking measurements like customer awareness and satisfaction, perceived performance, because they affect future sales and future performance of the firm. They're like indicators of how the company will do in the future. They're not reflective of past performance per se, but they hopefully will give us some forecasting tool methods to be able to anticipate next period sales and so on and so forth. So forward-looking metrics that are marketing focused are particularly good to look at. But also, if we look at backward-looking metrics, it gives us a perspective on what we've done and how we have performed in the past. And so these are things we often look at because we've collected data and we have this data. And so incorporating, again, marketing metrics with your traditional internal financial metrics becomes absolutely important. So moving forward, we want to talk about something called the marketing profitability, which would be the net marketing contribution data that we can collect and that we can actually measure. And when we start to look at this, what we want to think about are adding and using marketing metrics with traditional financial metrics. So here we have a traditional income statement or metrics that you'd find on a traditional income statement. So we have sales, cost of goods sold, we have a gross profit, and then we also have a sales, general, and administrative expenses all grouped together, as well as operating expenses, which when we subtract those out of our gross profit, we'll end up with our operating income, which we can then calculate a performance metric of operating income as a percentage of sales. Now, what we would suggest is that we take this category here and we take out of this one line marketing and sales. And so what we'll look to do is expand this where we take marketing and sales out. And from marketing and sales, what we're going to want to do is actually generate something called net marketing contribution. So we're going to generate this NMC amount, this figure, after we take out the marketing and sales expenses, and then we're going to be able to calculate the effectiveness that marketing and sales has on revenue and profit and operating income and so forth. But if we don't take that out, then we won't be able to discern exactly the effectiveness of our marketing function. All right, so step number one here is to separate marketing and sales expenses. So MSE is something we might say there. So marketing and sales expenses from the general and administrative expenses. So in this case, we had the general sales, general administrative expenses, 23.5. We're going to take out marketing and sales. And so that's going to be the first step. Number two is we want to combine the remaining general and administrative expenses with other operating expenses. So we actually take the general and admin and we combine other operating expenses together. Okay, so we had the 15 plus the 5 left over, so we have the 20 there. Okay, after doing that, so that's step number two. All right, and you want to walk through these. You might want to pause the video at some point and just kind of walk through these on paper, just so that you get these and kind of think through the process of what we're doing. Next thing we want to do is to calculate the net, that should be net marketing contribution. We subtract the MSE, so the marketing sales expense, from gross profit. Okay, so we have a gross profit figure here. We want to subtract marketing and sales expenses, and what we're left with is our net marketing contribution, the NMC. And basically what we're saying here is, you know, as a result of doing our marketing activities, it has contributed, in this case, $30 million to the gross profit of the firm. That is like the effect of the marketing and sales function on the profit piece that we have there. That's basically what we're saying. Then finally, we want to subtract the MSE and the general administrative and other expenses from gross profit in order to get yield our operating income. Okay, so we go ahead and take our MSE. We go ahead and take general administrative away from the gross profit, and we end up having our operating income right there. Okay, so that's how we incorporate this. So we calculated in this one step here, we calculated net marketing contribution. And then we also we separated out the marketing and sales expenses from the other expenses to make it all seem to work properly. As another illustrative example of what we did here to get net marketing contribution, what we began with our gross profit, and then we took out the marketing and sales expense, and what we were left with is our net marketing contribution. So if you add back the expenses and the contribution, you get the gross profit. They would add to that together. So this is, again, just a visual illustration of what's happening in order to produce that profit. Another way we can look at this, and we can walk through a flow chart to talk about net marketing contribution as well with this exact same example. And in this case, what we're going to do is we'll have our sales revenue. And the way you get your gross profit, which we kind of went over, we used in our last example, is we multiply sales by margin. And so if we multiply sales by margin, then we have a gross profit of 48.5, which is where we come from there. We have our MSE, our marketing and sales expenses. And so that's what we use. We subtract our MSE from our gross profit to get our net marketing contribution, right? We then can carry this other operating expenses over here. So we can subtract our other operating expenses from the net marketing contribution and have our operating income. But the other thing that we can do here, which is super beneficial, is we can calculate our marketing return on sales. And to do that, we simply want to divide our net marketing contribution by sales. So we have 30 million divided by 125 million, which yields us 24%. So 24% is what our effectiveness, this is the effectiveness rating or effectiveness rate of our marketing activities and how we contributed to sales from the marketing unit. The other thing that we can calculate is the marketing's return on investment. So we have had expenses. Those expenses are how we view or should be viewed as an investment, and so we take our net marketing contribution, divide it by our marketing and sales expenses, and we get basically it's a return on investment, right? So we put in a certain amount of money, and out of that investment we get a profit back. And what that profit is, the marketing's contribution to the whole piece of the puzzle, is 162% in this particular case. Okay, so being able to separate marketing and sales expenses from general administrative expenses allows us to identify the contribution that marketing has towards profit. Once we're able to do that, we can calculate a return on sales and a return on investment, like a ratio type of a thing, to be able to begin to gauge performance effectiveness in marketing. So these two profitability ratio metrics allow us to compare our company's performance with other parts of the business. So if we have different strategic business units, if we have different product lines, if we have different operating units that are regionally located, we can compare one to the other. So we can compare products to each other and so on and so forth. Some more illustrations to provide kind of another glimpse of this, particularly the ROS. We have the return on sales and we have the net marketing contribution. Again, we have our calculation that takes place here. 30 million divided by 125 million would be 24%. If you want to make it into an index, you can multiply it by 100 or whatever, but it's 24%. So this marketing profitability metric then tells us the proportion or the portion of sales that are related to or an effect of marketing and marketing profits. Another illustration, so we just saw ROS, this is ROI. What we want to do is look at our expenses, and again, I hate saying expenses. We ought to just change that. We ought to call it marketing and sales investments, because that's what it is, right? Because we only spend money in this area with the anticipation that profit will come. So that's a good thing. I mean, you wouldn't spend this money and lose money, I hope. I hope there wouldn't be a negative net marketing contribution. That wouldn't be good. So anyways, this is an investment, and here again, we have our NMC, 30 million divided by our investment cost or investment rate, 18.5 million, and we get our ROI. So you can interpret this to say that for every $1 invested in marketing and sales, you yield a profit of $1.62. So, and again, that's the effective rate of what we're doing here. So here are some ways then that we can calculate the effectiveness of marketing within the firm and be able to demonstrate some good things that are going on there and why we should continue to invest. It's sometimes difficult to know benchmarks. That's a challenge that we have, understanding what the benchmarks are for the rate in which marketing and sales, the cost marketing and sales has relative to other general expenses. Most companies don't necessarily report separately the marketing and sales expenses, and so it's difficult to maybe benchmark or know. However, research has been done which indicates that roughly 70 to 75% of general and administrative expenses that would be reported, or the sales and GA expenses that are reported, are found to be marketing expenses. If you don't have a clear measure, or you have a lot of difficulty separating within your financial statements, separating out MSE from sales and general administrative expenses, then you might use 75% as a benchmark. So if you take 75% of the sales and general and administrative expenses, then that could be what you use for the number that you use for marketing and sales expenses. Okay, so that's not perfect, obviously, but it might be something that could help as you're beginning this process if your company does not already pull out that expense for you. All right, so now we're going to shift gears slightly and provide a little bit of an example of how some of this could be used across different products. So here's a product line example for a sportswear company. This sportswear company has a number of different products that they provide, that they offer to the marketplace. So they have pants and windbreakers and shirts and shorts and sweatshirts. And then we have a company total here which sums up their overall performance. So here's an example where we can look at the effectiveness of our marketing functions across several different product categories within the firm. So now, rather than looking at the firm level data, we're looking at product level data, and we can begin to understand how well products are performing within the context of the firm and how profitable products are. So we're going to look at this top box first. And this top box will look at each different product, and it will suggest that some products are performing well, others are not performing well at all when you look at the net profit that is produced. The net profit that is produced. Now, here's the thing that we want to look at. So if we strictly look at this and we're saying, well, you know, we want to become more efficient, we want to drop products that aren't producing profit for us, definitely casual shorts are something that we want to think about eliminating. That makes sense. I mean, it's intuitive to certainly think that. Now, from a marketer's standpoint, there are some reasons why you might not want to do that. One is, as a sportswear company, you might feel like shorts are an important product to have in your portfolio, even if they don't make you money, because somebody may buy shorts, but they also might buy a polo to go with it. And so when you do like product bundling, we'll often look at the profit margin and the profit of the two products put together as a single unit. And so the person probably wouldn't buy a polo if they couldn't buy the shorts to go with it, and so forth. So there are some other reasons to think about other than purely financial before you drop a product or add a product. And that would be like the effectiveness of the effect of complementary products and so forth in your product mix. But if we drop down below here too and we expand our financial analysis and we incorporate the net marketing contribution into this mix, and so what we're going to do is we're going to take out the marketing and sales expense out of this line that's operating expense here. So like for instance, for khaki pants, we had $18.5 million, it looks like, in operating expenses. But what we did was we pulled out the marketing and sales, which was $8.5 million, leaving $10 million for the net operating expenses. And once we do that, once we take out that expense, then we can calculate our net marketing contribution for each product line. So we're going to see here, and we're going to say, wow, okay, now granted, casual shorts isn't like producing a huge contribution to our overall expenses, but it is positive. Like as before, you know, we were only looking at this -1. Now at least we can see that it's producing some contribution to the bottom line. And that's kind of a big takeaway when we move forward as we look at this a little bit more. So again, we've got this +1 here, and we've got to reconcile that with this -1 as well. So the finance manager is going to come and say, all right, let's consider dropping casual shorts. This will help improve profits. Now the question is, will it help us improve profits or will it not? At the end of the day, we've got a lot of data that's expanded here now. We've got market demand, we have our market share. Again, we don't have huge share in that particular area. We don't have a lot of units we're selling. And we've got all this other data that's available to us. We have our actual sales price. Sales revenue for each unit that we sell, our sales margin. All of these are weak for casual shorts compared to some of these other categories. Gross profit. Again, though, we look at our sales expenses, and the direct expense in this particular product category is not high relative to our other categories. And that's one of the reasons why we have a positive net marketing contribution. Now, we have to dig a little bit deeper, and I really want to emphasize exactly what we're talking about when we're talking about net marketing contribution. And this builds a little bit deeper, and this is a really, really big key concept. There's something that we focus on, especially in pricing, called contribution margin. So a contribution margin is the portion of profit margin that's left over after accounting for direct or variable production costs. So we have variable costs and we have fixed costs when we think about the cost structure of a product. When we have revenue and we subtract out the variable cost, we have what we call contribution margin. Okay, and basically the idea is the contribution margin is the portion of profit that we can pile on into fixed costs. So like I produced a product, I sold the product, I've paid my variable costs off, and whatever's left over I can contribute to paying down fixed costs. Basically what's happening is the net marketing contribution is very, very similar conceptually to this leftover amount of profit. It's the amount of profit that's left over after accounting for marketing and sales expenses. So as a result, anytime you have a positive net marketing contribution, whatever that amount is, and in this case, the shorts are $1, right? Or one unit or $1 million, I guess is what it is, because it's in millions, the scale is in millions. That $1 million is something that we can contribute to other expenses in the firm. So even though it appears as though that's a non-profitable product line, because of that -1, the reality is that that one product line is actually contributing to other expenses in the firm that if we eliminated it, it otherwise wouldn't be. Okay, so when you think about once you separate the marketing and sales expenses, all the other expenses can be thought of as basically an overhead cost, an overhead cost to do business without a direct line of contribution from a direct product. So when we do this operating income, we calculate operating income, then we take the sum of all of our products' net marketing contributions, we subtract out the expenses, both G&A and then other. Okay, and then that's what we get from the operating. That's how we actually calculate operating expense or operating income in this particular case. So if we do this, we keep the $1 million associated with that product. We have the net or final operating income of $10 million. If we didn't have that product, then it would be zero, right? It would go from 1 million to 0, which would actually give us an overall net operating income of $1 million less. So again, individually, right, that is not a profitable product line. But if you take the basket of products together, if you put them all together, the net effect is better having it than not having it. It's basically the bottom line, because it's still contributing to overall expenses, much like contribution margin is what we use in pricing to calculate what part of the price or what part of the profit margin contributes to the overall expense of operating the firm as a whole. So operating income will drop by $1 million, but it's also the exact amount that the casual shorts product line contributes when we calculate net marketing contribution. And this is because general and administrative expenses and those other expenses don't have a direct attribution to a specific product line. It's costs that's spread over the entire firm. All right, so again, looking at this from a kind of a flow chart type of perspective, we have units sold, and then we have our market share, which gives us our volume. We have our average sales price, and then our net price that goes in here. So if we multiply our volume of units sold by our net price, we have our net sales dollars in dollars there, right? We have our unit cost in this case. So from our unit cost, we can calculate our percent margin. So our percentage margin then is 40%. We multiply our margin by our sales number to get our gross profit, which is something that we did earlier. So we actually did this earlier in the earlier examples. And then we have, again, our expenses, our MSEs, which we can then calculate our net marketing contribution from. So this is, though, specifically for our khaki pants. So if we go back to our data, we look at all of these figures in the khaki pants category, right? So we had our market demand, our market share, we have our sales price, which are net selling price after we have channel discounts. We have our profit margin. We multiply our profit margin by our unit sales, and we get our gross profit. And then we use our gross profit and our marketing and sales expenses to calculate our NMC. And we get our marketing return on sales, 25.8%. And then we can also calculate our marketing return on investments too, which is also handy as well. We can actually take these two guys, combine them together, and take a look and see how our products fare together when we look at return on investment and return on sales simultaneously. So we calculate return on sales here, just like we did before, where we take our NMC divided by sales, multiply it by 100, 25.8%. We also have our marketing return on investment, just like we calculated earlier. Together, though, we begin to get a really good picture of all of our different products. And this is just an example. So I just calculated this for khaki pants. We could also do it for the other products that we have here as well. Casual shorts, again, not the strongest product in our portfolio, but still producing contribution to overhead costs, as we've kind of looked at before. So now we've got a product portfolio, and we can look at the effectiveness of each product within the portfolio as it relates to our marketing effectiveness. Classic polos have the most pop for our marketing dollar, if you will, because of where they're positioned here, and then it kind of goes down from there. We can also, interestingly enough, flip this around. So this is a product perspective, but what if we looked at different market segments and we measured the effectiveness of our marketing efforts by market segment? So now we've got traditional buyers, fashion seekers, trendsetters, and then we have our total company outlay here. So we have a company, and basically they have 3 market segments that they're trying to focus on, and we have different volumes, different share, market shares within each one. We have different profitability levels for each one. So we have different percentage margins that we're able to charge and realize based on our cost structure. And we have different degrees of marketing, net marketing contributions here too. So traditional buyers, it would appear, are very profitable for us. relative to our effectiveness in marketing to them. So the marketing work we do in that market segment is very effective. And it's still effective in this other areas. We still have positive marketing contributions. So there's no suggestion we should drop a market segment here. But we certainly understand that this category is our most profitable, most effective. We reach most effectively from our marketing activities. And then second would be our trendsetters, and then finally the fashion seekers. So these tools can be very powerful for us marketers to be able to determine a strategy and also be able to determine within the firm and the way we do business in the firm and the way we function relative to other performance indicators, this kind of gives a real clear picture of that. Finally, we'll wrap up here with another flow chart, two more pieces here. A flow chart that shows the traditional buyer market segment, and again walks through reaching the net marketing contribution at the end. And again, we can do this for each of the 3 different market segments that we have. We calculate the gross profit, and then we multiply, which is the multiplication of net sales and margin. And then we use gross profit and our expenses here to calculate our net marketing contribution. So that again is kind of illustration, right? If it's easier for you to understand the process through a flow chart. The final thing that we'll look at here, and we'll just touch on very briefly, is that net marketing contribution can be influenced from the marketing decisions and strategies that we choose to enter into. So we know that market demand is an issue. So how many people are willing to buy our product? We want to look at demand specifically, and then we want to think about market share and how we can grow our market share. We can manipulate our price. We can maybe increase our price because maybe we build more value into the product. We have other effects, like there's a cost of distributing the product throughout our channel of distribution. And then there's cost issues that get built into our margin, and there's also cost issues and efficiencies that we can gain from our marketing processes. And those all contribute. All of these pieces go into contributing to net marketing contribution. So if we want to increase our NMC, then there are things that we can do to grow market share, to increase demand for our product, to raise our price without lowering demand. We sales price and demand are negatively correlated. That's a negative relationship going on there. So we have to be careful about that. We can work closer with our channel partners to help reduce those costs and so forth. So this has been a discussion then about different marketing metrics that we use to help defend and explain the effectiveness of marketing activities within the firm. And so anyways, that wraps up this video lecture.